Hi, Jesse Durham here, and today's subject is buy term and invest the difference or become your own banker. It's a heated topic, it's highly debated. Let's dive in and start defining some of these subjects so that we can make our own decisions. Term insurance is a low premium insurance that is set in force for a term or a specific set amount of time. It could be 10 years, 20 years, 30 years. And it may or may not have riders attached to it, attached to that policy. And unless there is a death during its enforcement, there will be no payout. So a term insurance is for a set amount of time. It's relatively inexpensive as a premium, and it only pays for that set amount of time. Now, whole life, on the other hand, is a permanent life insurance. And there are many characteristics to a whole life policy. It could be a 120-year policy. So again, it's a permanent life policy. But with that policy, there are attributes such as it's transferable. There are tax deferred and tax free implications. There is flexibility in that policy. There is protection against the market as it's not connected to it, being just standard whole life insurance. It has cash values that are accessible as withdrawals or policy loans, and we'll dive in on that more soon to come. It's normally protected against litigation, and there are just many, many more attributes to whole life policy, and it therefore normally has a higher premium amount than term life insurance does. But on the surface, those are the apples and oranges that we are looking at. Now, in whole life companies, there are two different types of companies. One is a stock company, wherein the stockholders are the owners of the company. Whereas a mutual life insurance company, the policy holders are the owners of that company. So stock companies, mutual companies, again, we suggest that you pursue policies from a mutual life company. We'll talk more about that. We'll talk more about the benefits therein also. All right, let's talk about this concept of buying term and investing the difference. And I will take, for example, Dave Ramsey, because he's a very outspoken proponent of this idea. Now, I would like to preface by saying that I love Dave Ramsey. He is a funny man. He is sarcastic. He speaks it like a language, sarcasm. And I listen to him and I laugh, but I respect him as a husband. He's a family man. He is a businessman. He is an investor. He's built a massive and incredible team. He's a best-selling author, multi-millionaire. I have much, much respect for the man. So let's take some looking at what he said about the subject beyond that point of buying term, exclusively term, in every case, in every situation, regardless of what things may look like, and invest that difference. And he has a very set and specific way that he encourages others to invest. And we'll also take a look at that. Now, I've personally heard via the radio and clips and YouTube and etc. But I've personally heard firsthand from recordings where Dave Ramsey has said, buy term and invest the difference, where he has said to look at policy structure and policy price when looking at a life insurance policy. That is good advice. I will say that is good advice. He said certain things like, whose money is this? So let's just dive right in. Whose money is this? He said that in regards to the owner of a whole life policy accessing cash values either via a withdrawal, but normally as a policy loan, which is why there's an interest to be paid back to the insurance company because there's a loan being made. And Dave's point there is, why should I be paying interest on an insurance policy that I funded? That my premium payments, and he may even use the word investment, it's not an investment. Regardless, why am I having to pay interest for my own money is his idea there. Now, I would like to make a clarification. When a policy loan is made for the cash values in a policy that you own. The company is not giving you money that you have paid into your policy. It's not like a checking account or a savings account where you're going and you're making a withdrawal. You are making a loan with the insurance company, just like making a loan with a commercial bank. Therefore, there will be interest charged, obviously, because the company, the insurance company, has written you that loan according to how much cash value you have in your policy from their general account. So again, your money, if you are making policy loans, continues to grow, compounding uninterrupted, which is the beauty of a policy loan, because your premium payments just keep growing and growing at an interest rate that's compounding upon itself, while you still have access to your cash values via a policy loan. So there's that clarification right there on why you pay interest to an insurance company, and it's because they've written you a loan according to your cash values in your policy from their general account. Now, another subject that has been brought up before is that the cash is invested when it's been paid into a whole life policy. And that is just not true. The IRS, which is actually predated by whole life insurance, so that's really interesting. And it does have, therefore, those tax deferred and tax free advantages. But your premiums that are paid into a policy are simply premiums for a death benefit. Those are premiums for mitigating risk for some person that may be key in a church or a business or a family. So it's simply a mitigation against the risk posed of losing that person too soon. Therefore, those premiums are not cash being invested. You've not bought real estate, you've not bought gold, you've not bought anything that's an actual investment. It is simply a policy. Now, we can use a policy as the preferred tool, obviously a properly structured dividend paying policy with a mutual company, a whole life policy with a mutual company. We can use that tool for the infinite banking process, absolutely. But the premiums paid into a policy are not an investment. They're not practically an investment. They're not technically an investment. They're not, according to the United States federal government and the Internal Revenue System, a cash investment either. So that's really important to remember as well. To be fair, yes, whole life policies are more expensive than term. That much is obvious when looking at what term provides and how the actuaries have built those policies to provide a death benefit simply for a certain set of time, and it doesn't cost very much because there just aren't necessarily that many payouts due to death in that. Whereas with a whole life policy, the policy is 120 years. It would seem that I would suggest that most everybody will cash in on that policy. That policy will mature one way or another, whether we live to 120 like I plan to do, or we pass before that time, we graduate before that time. And again, the death benefit is only one reason to have a life insurance policy. You can't have too much death benefit. However, there are many other things that we've addressed here that are characteristics that are desirable in a whole life policy. Regardless, let's make note of how a whole life policy is more expensive, or at least has a higher premium than a term insurance policy. And that high premium, again, in the banking world, in the infinite banking concept, is looked at as a deposit into our bank, our own personal private bank that we own and access and control. Now, have you ever made too many deposits into your bank account? Your traditional commercial bank account. Have you ever made too many deposits into your account? See, Nelson talked about how we can't be scared, we can't be afraid to capitalize our system. That was one of the staple principles in becoming your own banker from the book. We can't be afraid to deposit into our bank account. We can't be afraid to capitalize our system. We can't be afraid to amass capital that we will use to finance our personal lifestyle or our business or our investing, just our total financial footprint. We can't be afraid to capitalize. Every premium payment must be viewed as it is a premium payment for a life insurance policy, a whole life insurance policy, but also as the deposits that capitalize our banking system. Can't make too many deposits in your bank. Now, it's also been said that cash values die with you after just sitting there. So cash values just sit there and then they die with you. And Dave Ramsey has made a big point before about not receiving cash values upon your death, or your heirs not receiving cash value on your death. And he says you're only being given the face amount and you lose all of your investment. And again, that's not my word, that's not correct. And yet you lose all of that investment and you only get the face amount. Well, to address the first part, do cash values have to just sit there? They can. That's your choice. You're the owner of the policy. You have access to the cash value of the policy. You can make withdrawals. You can make policy loans. Again, we encourage policy loans simply because there are no interruptions to the growth, the compounding of your premiums that are being paid. And also, there are no tax implications in receiving a policy loan from your policy, cash values. And then also, the second part of, does it die with you? Do your cash values die with you? To be able to address that, no, they don't die with you. Cash, and again, we'll just answer this by defining some things and you arrive at your own conclusion. But a cash value is simply a representation today of the future face value that the life insurance company is promising and is unilaterally contracted to provide upon your graduation, upon your death. Therefore, it continues to grow day upon day until the time of its maturity when it reaches the full face value. So yes, you don't get the two amounts that you would see on any paperwork from the company, because the cash value is just a representation today of the face value 120 years from now, or 100 years from now, or 80 years from now, just depending on the structure of your policy. So it's a straw man argument to say that you lose, that you give up and you forfeit and you just lose the cash values of your policy. You don't. You have access to the cash values of your policy for the lifetime of the policy. And then ultimately you receive, or your heirs receive, the death benefit, the full face value amount, minus any policy loans that may be outstanding at that time. So it's simply not true that they just have to sit there. Again, that's up to you. You get to access when you want, or leave that, because again, there's no better warehouse of or location for your wealth than in a policy that you own and control that has all these attributes. But then also, it's misleading to say that you lose your cash values and you only receive the face value. Cash values are just a representation of the face value. All right, this is a big one. The idea that a whole life agent or anybody could be earning a commission or a wage or a salary or a fee, and how that's somehow due to the fact that something was done wrong, morally, ethically, legally. The book that I follow says that the laborer is worthy of his hire. And again, what I found to be true is that we receive according to the value that we provide. There's not a lot that goes into an algorithm that kicks out a term whole, a term life policy as much as goes into a whole life policy that gets properly structured for the banking purpose with a mutual company that's well established and has been paying a dividend for well over 100 years. That's a much different scenario. So to say that the professional that is doing that construction, that is building that policy and doing the legwork of having a good conversation with the applicant by having that policy reflect their intended purposes, both for the present but also for long range, as Nelson Nash always encouraged us to think long range, to think multi-generationally, they are worthy of that hire. They are worthy of that wage, that commission, that fee, whatever the case may be. In the insurance world, it is the insurance company that pays agents that are writing policies by representing those companies. So it's actually not something that comes directly from somebody who's procuring a life insurance policy for themselves so that they can be their own banker by having another asset, by having another policy in their system. The insurance company itself pays the agents for what they're doing in representing the company. And then, of course, it's much more beyond that to structure a policy for banking purposes, because in many cases, an agent would be making less, would be earning less for the work that they do by structuring a policy to have the cash value access that a banking policy will have. So there could actually be more money made by just doing it straight and traditional instead of putting the work in to construct a policy properly for banking purposes. Next, let's ask some broad questions. When having a discussion about insurance or money or banking, just anything along these lines, really anything, let's just consider the source. I have a good friend that's always told me to consider the source. Let's just ask, has this person read R. Nelson Nash's book, Becoming Your Own Banker? Do they or do they not control the banking function in their own life with their opinion? What are their credentials? What's their academic background? What's their practical background? Again, I wouldn't necessarily say that we should put too much emphasis on academic instruction and papers on walls. I'm not invalidating those. If somebody is perfecting their craft, if they're bettering themselves in their trade and profession, that's amazing and fantastic, and it's as it should be. However, there's a great difference in between what is done academically and what is done practically, meaning rubber meets the road, has been done personally, firsthand, by the person that is speaking. So, food for thought when taking opinions or comments from friends, family, business partners, relatives, neighbors, whoever the case may be, is just let's simply ask these questions. And we can respect everybody for where they're at. Dale Carnegie actually said that every man is my superior in some way. And in that, I learned from him. But if somebody doesn't have the practical or the academic experience that we're looking for in a set area, in a particular area, then we'll just take that with a grain of salt, perhaps. So, have they read the book? Are they performing the banking function in their own life, in their own business? And then we can go from there in our conversation. Again, this has been a great pleasure for me. I hope you've arrived at your own decision or made some progress in the direction in finding out whether you should be buying term and investing the difference, or whether you should be your own banker. Thanks. We'll talk to you next time. Take care.